65 years old in retirement, how much should you have in stocks? I've got that and more coming up. My name is Mike Bernardo, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Got this question recently. 65 years old. I look at my portfolio. I've got 82% in equities in the stock market. Is that too much? I get it. It's tempting to at retirement or approaching retirement to have more in stocks right now than in bonds, right? We've just gone through the worst 3-year time period for bonds, I think, ever. If you are a conservative investor or in retirement or at the cusp of retirement and you've thought, well, I'm just going to have, more in bonds or half my portfolio in bonds, that's going to be safer. It has not felt safer over the past few years. Absolutely not. Where stocks, the U.S. stock market, large cap stocks, now back to all-time highs where it was at the beginning of 2022. Bonds are not. They are not back to where they were, and so you felt punished. That safety and security that you expected from bonds has not been there, and therefore I get the reason to shy away from bonds. We've talked about that before. But then in last year, 2023, the stock market came roaring back, had a phenomenal year, and pretty much all analysts who were wrong the year before, but we forget that. They're all expecting great news from Wall Street and a great year ahead for stocks. And so I get it. It's tempting to own more stocks, have a greater weighting towards stocks than bonds at 65 or at retirement. Once again, there is no one size fits all, guys. We do comprehensive financial planning, and that's the approach that you need to take. Looking at all 6 areas of your financial life to see how you can make financial decisions that bring synergy to those areas, okay? And that certainly impacts your portfolio as it relates to retirement and your cash flow and all of that. And so how do you make that decision? I have seen from the planning process, I've seen folks with the appropriate mix of around 50-50 at age 65. I've seen a lot of people in the 60-40 to 65-35 range. I've seen some folks at 80-20 where that's right for them. Guys, I've even seen some where 100% zero, 100% stocks is most appropriate. How do you know? Your financial plan. And that's not just some opaque or sort of just overgeneralization. Your financial plan helps you determine what the right mix between stocks and bonds is for your situation. So here's the planning approach. When you are still a few years out from retirement, honestly, you should start this in your 30s, 40s for sure. If you haven't started it by 50, that's probably a little bit too late, but you need to be doing that 5-factor retirement analysis to see, are you on track to retire? This is when retirement's still a long way off. You want to look through, okay, what age do you plan to be done working and what's your life expectancy? So age is the first one. How much are you going to spend? And this is a key variable. How much do you expect to spend in retirement? And that is, just your normal monthly expenses, but then, plus health insurance and plus some one-time expenses and add in taxes and combine an inflation rate on top of that. So how much do you expect to spend? What are your income sources in retirement? So what does Social Security look like? Will you have a pension? Do you have other sources of income? What's your overall portfolio? How much do you have saved up for retirement? And what are you saving on an ongoing basis from for the rest of your career? And then how much risk or investment return or investment risk are you expecting? Because that risk and return, there's a connection there, okay? So you've got to look at all 5 of those factors, and then they're each interrelated. So you make a decision in one, it's going to influence the others. And doing that, and with your CFP, that's going to help you get a sense for, are you on track? Are you on track for a confident retirement, or do you need to make some adjustments? Do you need to make some trade-offs? So that's the planning work that you need to do in your 30s, your 40s, your 50s, and just continue to update it to make sure you're on track. Now, okay, from that 35,000-foot view, a lot of assumptions. As you get closer to that retirement age, you start firming up some of those assumptions. Sometimes they can adjust and influence. You want to make sure that you're still on track. But as you then get to your descent, right? You're within a year of retirement, or you're very close. As you begin to make your descent from that 35,000-foot view, You then start looking at your portfolio and saying, well, we know all this 5 factors, it works, but all right, now where's the income going to come from? And you start doing that math between what your spending needs are and what your income sources are. And that's going to reveal what the gap is. And that gap, you've got to determine with your CFP, well, how are we going to cover that gap? Are we going to structure the portfolio for income because we're going to be able to kick off enough income to provide what we need and fill that gap and then some? And therefore, we're not worried about a ratio between stocks and bonds. We're just more worried about how can we get that right level of income with the least amount of risk. Or I would say that's less common these days. Well, what do we need to withdraw from our portfolio in order to fill that gap? And in doing so, take for example, that gap is $3,000 a month is what you need to draw from your portfolio. Hopefully a lot of it's is made up of income that your portfolio generates, but you need to draw $3,000 a month. Well, structuring your investments so that you have the right amount of short-term, kind of low-risk capital preservation dollars, and then intermediate-term dollars, and then everything else is long-term. We call that your personal pension plan. So in this scenario, say for example, I need $3,000 a month to supplement my Social Security and income sources. $3,000 a month for a year, that's $36,000. For 3 years, 3 years worth of cash would be about $100,000. I'd have about $100,000 sitting in a low risk, whether that's a CD ladder or money market or something very, very low risk, so that for the short term, about 3 years, you don't have to worry about market volatility. You've got enough income, you've got enough cash and cash reserves that if we see an 08 or if we see the national debt create all sorts of concerns or there's a misstep by the Fed or something happens, you've got that safety for at least 3 years. Then you do that same math and say, well, how much would I need to put in medium risk or in the intermediate term bucket to provide enough income or cash needs for the next 7 years, okay? And that can be a blend of maybe longer term CDs or bond ladders or maybe some hedging strategies, something that's taking medium risk, maybe giving you some income as well, so that as you spend through that short-term bucket, those first 3 years, you've got another 7 years worth of dollars that's replenishing that first year, okay? Now, when you've done that math, when you've done that planning, you've got 10 years worth of clarity as to where the dollars are going to come from. That is not completely insulated from market volatility, but mostly insulated from market volatility. If you've got 10 years worth of that clarity, then the rest of your portfolio that you're not going to need to touch for at least 10 years, you can invest for the long term. Now that doesn't mean invest speculatively. It doesn't mean invest, as aggressively as possible. Maybe for you to sleep well at night, that long-term bucket, those dollars should be 80-20, or maybe those dollars should be 60-40. And as long as then that overall math provides a certain level of risk and return for you that fits within that 5-factor retirement plan, then fantastic. But this 3-bucket approach, or we call it a personal pension plan, this is how pensions structure their dollars, where they're paying out large sums of money for as long as people live, identifying what do we need in the short term and have that structured for the short term. That should not be invested. What do we need in the intermediate term and have that structured medium risk or more income producing investments that have a certain term to them, maturity to them. And then everything that's long term, invest long term. For some folks, now going back to where I've seen how, it's just such a wide gap, you can't say it's not appropriate for you to have 82% in stocks, or it absolutely is, or whatever. I've done this math where we've got enough income and we fill up those first 2 buckets, and you know what? I don't want to take a lot of risk. So my long-term dollars, I'm comfortable at 60-40, and we do the math, and that actually your plan works with that. And therefore, when you look at all 3 buckets, it's closer to 50-50. See a lot of people that way. Most people, though, if I could paint with a broad brush, that long-term bucket is closer to 80-20, and therefore when you mix it all together, looking at someone's entire portfolio, it's much closer to 60-40 or 65-35. But we've seen some where we do that math and, your income sources compared to what your spending needs are, you actually aren't going to be drawing anything out of your investments, or at least not for the long term, for a while. And therefore, it's at that point where we say, well, what are you comfortable with? Because, assuming again that 5-factor retirement plan works, how much risk are you comfortable taking? And some are saying, comfortable taking a lot of risk. We've just done the math, and this money is not short term. Therefore, it's still long term. Let's invest it for the long term. We're not going to need to touch it. It's, the kids are going to inherit it. Let's invest it for them. That's where it's most aggressive, right? And other people say, yeah, we're not going to need to touch it, but therefore I don't want to have to worry about all the ups and downs, and therefore let's invest it more conservatively. Financial planning, comprehensive financial planning is the answer to what's the right ratio between stocks and bonds that you should have as you are at retirement or in retirement. Work with your certified financial planner on that. If you don't have a CFP on your team that can help you with that personal pension plan, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.